I want to welcome on today's guest, Mish Schneider. Mish is the chief strategist at Market Gauge, coming to us from Santa Fe, New Mexico. Mish, good to see you. How are you?
I'm great. Look at us all pretty in pink.
We are. We didn't even coordinate that. That just naturally
Exactly.
happened. That's how in sync we are, Mish, between these two locations. Listen, it's been an incredible year so far. You've been so generous at coming on the show regularly and kind of giving us some ideas. You've also been a part of some of our bigger market outlook discussions. We're at this point here in mid-June, or late June, which has usually been pretty weak for the markets, but we're seeing another rotation back to new highs. When you're looking at what's happening on a day like today, what are your takeaways? Is it still sort of long and strong continuing, or are there causes for concern?
Well, I'm always looking for causes for concern, right? The old wall of worry that we climb in bull markets. But at this point right now, my certain indicators that I like to look at in terms of the economic modern family would be what you're looking at right now, which is transportation. And transportation is showing a total risk on environment. And it's healthy because it means that the demand is good. And even if it's still concentrated in a few stocks, as people have said to me, it still means right now that looking strictly at that basket, we're in good shape. Now, it hasn't quite taken out that key area of 250 where it bounced to last time. But if the week continues the way it seems to be going based on all the good news, and of course, as you mentioned earlier in the show, the cruise lines rallying, the airlines rallying, it's just a matter of time that it could happen. But of course, that's looking at one pocket. And that's what makes this market so interesting right now, is that if you want to be a bear, you can find something to support that. If you want to be a bull, you can find a lot of things to support that.
I love that, right? Tell me what opinion you want to have, and I'll show you some charts. I'll give you some visual aids to back that up. But you're right. I mean, if you look at charts of transports, right? I mean, Charles Dow, his original idea was sort of thinking about this as a key area. In your experience, why is a strength in transport such an encouraging part of the picture? And I know it's part of your economic modern family. Why does it deserve a seat at that table?
Well, planes, trains, and automobiles, right? It's exactly the measure of how goods are moving, not just in this country, although it is a U.S.-centric ETF, but everywhere. And so if people are going out, if goods are moving in terms of getting deliveries and people are ordering stuff and the freights are moving as a result and people are traveling and getting on cruise lines, what does that tell you? That tells you that all of the hype that we have heard about how we were heading for this deep recession and that the market and basically the economy was going to be killed based on so many different factors, high interest rates, high inflation, that people are going out and spending money and doing things. And that's always a good sign.
So speaking of people spending money, your second set of charts are the retail ETF, the XRT. And just before you start, as a reminder, everyone, we've got the weekly chart on the left, the monthly chart on the right. You've got some really good ACP, a nice ACP setup to show those two different time frames. Strength in retail really speaks to the strength of the consumer. Why is this an encouraging chart here?
Well, it's not quite as encouraging as what we just looked at. So really, basically, what we can also make a case for is that the demand that we just saw, the strength of it through the transportation sector, the consumer hasn't really necessarily in terms of the XRT, which I like because it's a good blend of staples and discretionary caught up yet. So what does that mean going forward? That there's always a rubber band impact with some of these sectors that we look at. So if transportation is moving up higher and retail is struggling to keep up, then that may tell you that from a speculative standpoint, some of these stocks that have been carrying the transportation sector are getting a little bit ahead of themselves. So we have to continue to look at retail. Now, XRT, we just saw on the weekly chart that we were looking close to a yearly high in transportation. We can't even get over the 50-week moving average in this weekly chart or the 200. It's still actually in a weekly bear phase where transportation is in a weekly bull phase. And if we look at the monthly chart here, that 23-month that I've talked about so much this year to really measure expansion versus stagnation versus contraction, this is still in essence in a contraction. So if there's any caveat for this market going forward, it's going to be if this can't keep up, this whole area can't keep up, and actually starts to turn lower, eventually taking out the green line on the monthly chart, which would be the 80-month moving average, which would be a 6 to 8 year cycle. So that's kind of where we're at right now, which means exactly what you said before. Follow the trend, but certainly have a strategy when you're doing that. And of course, that's been really the case for a lot of the retail investors this year, which is a good thing.
Yeah, no, that's such a great illustration. I love the contrast between transports, the strength we're seeing there, and a very different picture for retail. It's a really nice illustration of that. You know what, we get a lot of questions about names that have had really good runs, and I'm thinking of some of the leading mega cap names, things like Apple and others. You know, from your experience, what do you do with a name like this? And I mean, I would assume if you're still holding it, probably don't do anything and just wait. But I mean, what if you're just coming in now with fresh money? Do you look at an opportunity like this and just consider it for further upside, or do you see things that cause you for concern on names that have already had such a run?
Both, actually, because yes, hopefully people were prescient enough to be getting into these mega cap stocks months ago. But I would say really as we were ending April, going into the period of May, it was pretty obvious that that was going to take off. And it was just at the same time where the Fed was talking pause, which really gave you the green light to get into these mega cap stocks, which were so undervalued in 2022. So they were right. At this point, are they still ripe? I think that's really a big question. So I would say if you're putting money in at this point, you always have to understand what your time frame is, what your risk appetite is. This is why this year has been fabulous for the math, for the pure math, for the algos, because our algos have been in these mega cap stocks and actually bought NVIDIA on the correction. And so what that's telling you is that we have tails in many of them. And so many of them could go parabolic still, and those tails can make a lot of money. But unless we get a serious correction like we just did in NVIDIA, there's no reason to put new money to work. And that's not my opinion. That's just based on how we've programmed our quant models. And Apple, interestingly enough, has kind of been left out of it. We haven't put any money through the quants in Apple, and yet here we are making new all-time highs. So I'm not quite sure what that means for that stock in particular. But if I were giving advice to people, I would say I would rather be buying corrections and not necessarily chasing strength, particularly after I just showed you the consumer charts, and we still really don't know how long the consumer will step up to buy particularly the things that Apple sells more than, let's say, an NVIDIA, which is chip oriented.
It's interesting as we think about the next couple weeks here. We obviously had the Fed pause earlier this month. Now, you know, very soon we're going to be talking about a July meeting and a reinitiation of continued. As you're looking forward a couple weeks, even a couple months out, what do you do now, or I guess, what do you anticipate we learn, and how does that impact some of the trends that we've seen year to date?
Well, one of the things I think is that even if the Fed raises at this point, I think we can pretty much all agree, and I know this is something we talked about in early May when I was out there with you guys, is that we are kind of at a peak in terms of how much the interest rates are going to be raised from a seasonality and a historical standpoint. So 5.25, 5.5, even 5.75, we're near the top. And obviously that's what the market senses right here. So I would say if that is the case, this is where I start to shop for opportunity. And if we are, as you so beautifully pointed out with the small caps, you know, my granddad of the U.S. economy, as a great measure of risk on, risk off, I'm so on your page. 1,800, it corrected to, that was a nice breakout from a yearly standpoint. But if it really, really is going to show some muscle, it's got to get through that 1,900. And as it's testing and held this week, we've been accumulating more basic materials, because if we're going to have any kind of expansion in this economy, which we would love to see, then you know that some of these basic materials have been so undervalued, and that leads to commodities, which of course could be a whole vicious cycle of inflation has come down, but as things grow, there's still a shortage of supply of a lot of materials. And if that starts to increase in price, then there we are again going through the inflation talk.
Round and round we go. I feel like we can't get away from inflation as the story here in 2023. We maybe have time for one more question here, but Mish, when I'm looking at the energy sector, one of the charts we actually featured, I think at the end of last week, was I think Devon Energy DVN flipped upside down just to show the fact that it's this nice sort of bottoming pattern if you flip it over. And it certainly feels, if you take a step away from your monitor, like this big sort of rounded topping pattern. Do you see opportunities in a place like energy that has lagged behind so much? And if not, what would you need to see to get interested in something like this?
Well, besides our pink outfits, I want you to know this question was also how much in sync we are, because I wrote my daily about that tonight.
Ooh, okay.
Because, yeah, right, XLE, I didn't look at Devon necessarily. I looked at XLE, the ETF. Mm-hmm. And what's so interesting about that right now is that we have a little bit of a divergence in that the real motion indication or the momentum indication is still negative, but it's starting to show signs of life on the chart in terms of the daily chart and on the monthly chart. This is a perfect example where we're seeing things trying to cross the 2-year business cycle on that 23-month moving average. XLE was already there. It's been there for a while, and all it's done is correct down to that level. So that tells me that I wouldn't discount energy at this point. And this definitely fits the discussion of round and round we go, because we know if energy starts to take off, then that's going to be the discussion again about inflation coming back. And I just want to say one last thing, because this is the most interesting thing I've seen in a long time. I got sent an article today about this guy who studies these 30-year cycles going back to 1933 of commodities versus equities. And in the 30-year cycles, you go 15 years where stocks outperform commodities, and then 15 years where commodities outperform stocks, and then it resets. And he's saying that June 30th, this week, 2023 starts a 15-year cycle where commodities will actually do better than equities. Now, that's a broad term, but in essence, it just sort of supports what everybody's kind of giving up on here in the energy sector. And now, all of a sudden, it's starting to look pretty darn interesting to me, as it has a really low risk to about 75, and it's trading at around 78, 79.
Really interesting, Mish, and thanks for bringing up the monthly chart. It's so refreshing to think about, even though we've had a lot of noise in the short term, how does that relate to the long term? That's such a great way of thinking about it. Mish, before we let you go, one question. We asked our viewers just recently, which sector do you think performs better over the next 3 months, consumer discretionary or consumer staples? How would you answer that question, and why?
Well, consumer staples are really a risk off, and right now we're in a risk neutral to risk on. So just from that answer alone, we would have to go with discretionary. But I thought about this question, and you know what's so interesting is that common sense versus what we're seeing have nothing to do with one another. And what I think has happened in society, and certainly we're seeing it in Argentina, which has 100% inflation rate, and yet they have been booming in terms of their economy as people going out, is that I think we've developed a fatalistic attitude as a society, in that we better get in now and take advantage of things before they get worse. We can't control it anyway, so might as well live our life right now. And I think that's kind of why I support the discretionary side of things, because people are going out and buying things because they want to enjoy life while they feel that we can, because anything could go wrong, right?
When in doubt, let's follow price, and there's no denying one of those sectors has vastly outperformed the other. Mish, it is such a pleasure to see you. Thanks for sharing some charts and ideas with us. Best to Keith and the team down there, and I will talk to you again soon.
Thank you so much, Dave.
That's Mish Schneider. Mish is the chief strategist at Market Gauge from Santa Fe, New Mexico. I love her sort of take, and what a great way to answer some of those questions. You know, it's so easy to get caught into the short-term movements, the short-term rotations. Mish's answers often went to the weekly and then the monthly charts to think about how these pullbacks and these rallies fit into the larger time frame. I think that is a great reminder of the benefit of thinking about multiple time frames, and I'm already going to be saving some of these ACP views to try to incorporate them into my own thinking. Great take there, as always, by Mish Schneider at Market Gauge.